also have the subject value computation there. So this is a summary here. So we're saying the summary reads as follows. So we have scenario 1, 2, 3, and 4 like that. So then we have comparable data. Comparable data. Are we comparing the subject property or are we using comparable data? So now once we have the comparable data, on this other side we have subject valuation. That. Then we have another column over here, adjustment. Adjustments. And these adjustments are important for comparable company data for the control there. So scenario 1, we are saying the comparable data over here has got a controlling interest. And here we also have a controlling interest. Like that, I can put that in short form, controlling interest, meaning that the investors have a controlling stake in that company or in the private company there. It's controlling interest, and here we are saying non-controlling interest, non-controlling interest, put it properly, there, properly, non-controlling interest, and here we also have non-controlling interest. So if we have a controlling interest, we could be able to have a controlling interest over here. So controlling interest, right, like that. So that is the subject valuation. The subject valuation has got a controlling interest, and the comparable data for comparable maybe private firms or even public firms which are in similar line of business. Once we have that, the adjustment needs to be done as 0. There's no adjustment because they are having both a controlling interest. In the second scenario, here we have a controlling interest, and then here we have a non-controlling interest. Non-controlling, you can put this line like that. That would be better. So that non-controlling interest over here. So here it is a controlling interest. Remember, the subject valuation over here has got a controlling interest. A subject valuation has got a non-controlling interest, but the comparable data is a controlling interest. So you need to apply a discount for lack of control. This is what you need to apply. The control premium component over there must be gotten so that you can be able to adjust for the comparable data there. So a DLOC needs to be applied there. Now here we have a non-controlling interest and we have a controlling interest like that. If you have non-controlling interest and controlling interest right over there, we must apply a control premium. Must apply a control premium. In this case, what will happen is that we try and make the control premium to become the subject of the formula so that we can be able to solve for that. Now, non-controlling interest, and we have non-controlling interest, and we say that here there will be no adjustment that needs to be done like that at that point over there. So having looked at this summary for discount for lack of control, we now move on to calculating the total discount. How do we compute the total discount? The total discount, so we say total discount right there. We will have to combine the component of discount for lack of control with the discount for lack of marketability. So the formula will be as follows. We'll have 1 minus. Then we have now the component of discount for lack of marketability. 1 minus discount for lack of marketability. The product should be 1 minus discount for lack of control, like that. So first of all, you work out the brackets if you remember BODMAS. brackets off. So you start off with the brackets, you solve for this, you get this value over here, you get 1 minus that value, so that you can be able to get the total component of discount. So this is how we can be able to compute the total discount that should be applied when trying to measure the value of a private company there. And we're saying that this discount needs to be considered so that you can be able to try and increase the value of the private company required return, so that to account for the risks, the higher risks that are prevalent within private companies as compared to private companies, public companies rather. There. So having looked at the total discount, we move on to the final component, and we will be able to now look at an example that assists us to compute the value of minority interest. Minority interest for private companies there.